Well, good morning. It's me, Kenny Polcari, your host of the party. As you can see, it is still dark outside, right? I mean, it is about 6:30 and the sun should be coming up any minute. Today is September 16th, 2025, and here are the things you need to know to get your day started. Well, the algos continue to push the S&P higher. It ends in another new century mark. The equal weighted S&P, though, that closed lower. Is that something to be concerned about? Well, maybe. The FOMC meeting begins today. Both Stevie Moran and Lisa Cook will be at the table. Now, it's 25 base points today. It's 100 in total by next February, or at least that's what the market's expecting. And reminiscence of a stock operator-inspired recipe, the Wagyu smash burger. We'll get to that in a moment. And the week, well, it started off with a bang. Markets in celebration mode, and you can't make this up. All of the indexes closed higher, with the S&P kissing 6,600 before penetrating the close at within another new century mark for 2025. Now think about it. The S&P is now traded in 18 different centuries this year. From the low of 48.34 back in April on Liberation Day to yesterday's close at 66.15, it is nothing short of remarkable. At the end of the day, the Dow added 50 points. The S&P was up 31. The Nasdaq rallied by 207. The Russell was up 8. The transports, though, lost 52. And the equal-weighted S&P, well, that lost 16 points, which is kind of interesting when you think about the relationship. While the Mag 7 continues to push higher, up 613 points, or nearly 2%. The story hasn't changed. Traders and algos are excited and remain convinced that we're going to see 75 bips worth of cuts over the next 3 meetings, September, October, and December, with another 25 penciled in for January of 2026, right? That meeting is on January 27, 28. The narrative will now become not if we get the cut, but rather how fast future cuts are coming. Remember, Trump has been pushing for a big cut tomorrow, something greater than the expected 25 basis points. So you can be sure that Trump will not be happy if we only get what the market expects, which is 25 basis points. And he'll light up Truth Social with his own commentary on what he thinks, what should have been the right thing. Anyway, investors, traders, and algos will also be paying very close attention to the dot plot that is created at this meeting. Now, the dot plot is a chart, right? It's on graph paper with number 2 pencils marking a dot on the plot. It's published 4 times a year as part of the Fed narrative, right? Each dot represents where individual members, both voting and non, expect federal funds rate to be at the end of the next few years, plus kind of a longer run estimate, out. It's not a promise of official Fed policy. Rather, it is a snapshot of expectations. Markets look closely at the median dot as a guide for where the Fed might go, right? It's like the majority of Fed think. It's important to note, though, that the Fed is not suggesting that the plot is forward guidance by any stretch of the imagination. Economic conditions change quickly, thus the actual path of future moves is often different than what the chart initially suggests. Now, changes in the dot plot between meetings and prior meetings often signal shifts in Fed thinking, right? For example, if more dots at this meeting move higher, that suggests that, Fed members see the need for rate hikes. If they shift lower, then it suggests that they see need for rate cuts. The dots are anonymous. You can't tell who it belongs to, Powell, Waller, Daly, Barker, Bostic, whatever. But collectively, they show how the policymakers are thinking about the path of future interest rates. Now, you can assume who owns a dot based on any recent commentary maybe that individual members make when they're not in lockdown mode, but you can't really be sure. Doesn't make a difference. You could also thank Lonnie for some of the fireworks yesterday. Tesla shares jumped by 3.6% after Lonnie disclosed that he bought $1 billion worth of Tesla via a revocable trust on Friday. It was made public yesterday, igniting another rally in disruptive tech, and that helped propel ARKK, the disruptive tech ETF, up 2% on the day and now 40% year to date. Other names in that ETF include Coinbase up 30%, Roku up 26%, Roblox up 130%, Hood up 200%, Palantir up 126%, CRISPR up 46%, AMD up 33%, and the list goes on. Meanwhile, Google also surged 4.5%, officially joining the $3 trillion club. What was once, labeled an AI disappointment earlier this year has quickly become, guess what? A new AI darling. Remember, Google was left for dead earlier this year, down 32% on April 7th. But as of last night, it's now up 33% year to date, even outpacing NVIDIA, which is only up 32% year to date. Eco data today includes advanced retail sales month over month up 0.2, ex autos and gas up 0.4, New York Fed services business activity down 5.8, industrial production month over month of negative 0.1%, capacity utilization at 77.4, below 80 suggests less upward pressure on prices, and that's a positive. We're also going to get the latest NAHB housing market index of 33. Now, the scale is 0 to 100. Below 50 suggests builders see weak conditions. Above 50 suggests they see stronger conditions. But this should not be a surprise that we see a 33 number, because how long have we been talking about housing conditions? So that should be no surprise. The surprise will be if it's better, right? Bonds rose a bit, and that kept yields near their lows. The 10 years traded in a range of 4.02% to 4.08, only to settle at 4.03 this morning. It's steady. The 30-year yield traded in a range of 4.64% to 4.7%, only to settle at 4.66. And again, this morning, it is holding steady. Oil rose by 60 cents or 9/10 to end the day at 63.28, leaving it within the trend lines of 62.92 and 64.15. Keep your eyes again on 61.75, because if we break that, then 60 is around the corner. On the other side, there appears to be plenty of supply between 63.28 and the long-term trend line resistance at 64.37. And with global supply expected to grow, my gut says that the path of least resistance is lower. Gold surged by $35 yesterday to end the day at $36.78. And this morning it's up another $20, trading at $36.97. So I guess the idea that gold felt a bit fatigued, I was wrong. Partly because the move in gold can be directly tied to the move in the dollar. A weaker dollar equals stronger commodity prices. Now the dollar is down 11% this year. In gold, it's up 40% this year. And then when you add in all the uncertainty around the economy, the Fed, you also have the wars, you have this flight to safety. But if you look at the chart, the move just feels unsustainable, at least to me. U.S. futures at 6 o'clock are mixed. Dow futures down 15, the SPs are up 12, the Nasdaq's up 72, and the Russell is flat. Last night, the Senate did in fact confirm Stevie Mnuchin as Fed governor, replacing Adriana Kugler just in time for, guess what, today's meeting. Lisa Cook remains a voting member as well when the appeals court voted for a stay of execution while they consider what to do. European markets are lower this morning. Donnie and Melania have landed in the UK and will be visiting with the King and Queen at Windsor Castle before moving on to meet the Prime Minister, Keir Starmer, I think tomorrow. The unemployment rate in the UK held steady at 4.7%, remaining at a 4-year high, while earnings growth slowed to 4.3%, down from 4.8%, down from 5% over the last 3 months. The Bank of England is due to announce their latest monetary policy decision on Thursday. No rate cut is expected. The S&P closed last night at 66.15, up 31 points. This morning, markets are marching in line as the week begins. Now, a look at the chart also suggests that the recent move is unsustainable, reminding me of the famous John Maynard Keynes line, that the market can remain irrational longer than you can remain solvent. It reminds us just because markets don't make sense in the moment doesn't mean that they'll snap back right away. Prices can defy fundamentals for weeks and months, and some say even years, which is why patience, discipline, and risk management, rather than trying to time the market, is much more important. So let's review your plan. Call me for a complimentary no obligation portfolio analysis at 561-931-0190. Happy to have that conversation. Okay, so yesterday I told you that I had just released this free audio book in both actually English and Spanish on Spotify for investors new and old to enjoy. It's that 6-part abridged edition of that famous classic Reminiscence of a Stock Operator, one of the all-time great market classics, right? A century later, the lessons still hit home, and it feels relevant today as they were then. And so today, I'm giving you another recipe that is inspired by that book. And also the recent market action. It's a Wagyu smash burger, right? It represents the boom. Now, this comes with the mania. in the roaring 20s. By the way, the roaring 1920s and the roaring 2020s. Fortunes were made overnight as the stock market became a national obsession. It was rich, it was fast, it was intoxicating, just like the dot-com bubble or the AI frenzy is today. Now, for this, you're going to need 1 pound of ground Wagyu beef, salt and pepper, 4 slices of cheddar or American cheese, whatever you want, a large onion sliced thin. You need butter, you need 4 brioche buns, right? You're going to season the meat, divide it into 4 like loose balls, right? Like make meatballs. Caramelize your onions on low, slow, using butter on a low, slow heat, right? Heat up a cast iron skillet. Put nothing in it. Just put it on the stove. Get it really nice and hot. Smash the balls into the hot skillet. Wait till the skillet gets hot. Then put the meatball in there and kind of smash it down. Adding a dollop of butter to the pan. Sear it for 2 minutes. Flip it over. Add the cheese. You want to toast your buns with the butter. Delish. Now, when you build your burger, put the onions, and any other toppings that you choose, mayonnaise, ketchup, whatever you use. It's decadent, it's indulgent, and it's a little messy, the flavor of excess, just like when the markets are full tilt. Does that sound somewhat familiar? In any event, the day is just about getting started and the sun is just about to rise. So until tomorrow, take good care.